Bhavtosh Vajpayee, Managing Director and Head of Equities with Barclays. He joins us now. Bhavtosh, great to have you on ET Now. Thank you for joining us. What are your thoughts on the Indian markets right now, given the way how the environment is challenging and we are still working with sticky macros? What is your broad call on the market range for next 12 months?
So India is heading into elections, as we all know, and several macro variables continue to be challenging. I would say that the baseline for India remains sluggish, remains challenging. At the same time, there are a few aspects which could create pockets of hope. Now, these could be the allocation to India from emerging market portfolios, where you really have to compare India with other emerging economies. None of them, incidentally, are doing very well. So it's a question of relatively whether we stand out or no. Secondly, government spending could pick up in the run-up to the elections. There could be further interest rate cuts. And there could be a base effect on certain macro variables, be it the WPI inflation or IIP growth numbers. So I would say a very mixed picture with no significant breakout on the upside, no significant upturn in the economy expected. At the same time, flows will continue to drive the market. And to some extent, those flows will be determined by India's standing in the emerging markets world.
Bhavtosh, so how do you see the markets post-elections? Will equities take a turn for the better in your view?
Oh, and the picture will definitely change. For better or for worse is something that only time will tell. I guess what the equity markets would want is a stable coalition with the largest party getting at least 180, if not 200 seats. There have been optimists in the market who have been hoping for early elections. At this time, that is not our base case scenario. We do not think that will happen. So we have many months to go before we get to that point where we get an election result. And hopefully we get a result that yields a strong coalition. And that could lead the markets up. On the other hand, if the elections are inconclusive, things could actually take a leg down.
Bhavtosh, in a recent investor conference, you've highlighted that pharma could be the top theme for this year. Now, what's the thinking behind this call, and why are you still bullish on pharma after the recent run-up?
So healthcare overall has been one of our top overweights, aside from others. And the biggest driver has been sustained earnings growth. This earnings growth is coming not just from the domestic market, but increasingly from the US market. And now we are seeing signs of the rest of the world market as well picking up. We don't see that changing. If you look at most of the healthcare companies, they are looking at least 18% earnings growth over the next 2 years per year. Some are above 20%. And valuations are near about. So it's a good balance where earnings will continue to expand. New opportunities in terms of new drug filings continue to come in. And you have that faith of earnings expansion going on steadily. At the same time, there are certain tailwinds from the weakening rupee which add on to the story, but that's not the core of the story.
Right, so what's your outlook on the telecom space, and do you see recovery in these stocks as most negatives get factored in with the recent fall?
So the hope in telecom is that the sector will consolidate behind the key players. That has been happening if you look at the market shares of the key players which have been increasing. At the same time, a breakout requires better quarterly performance, better operating results, an end to the price war that has characterized the sector. And that, to an extent, will take time. We are positive on Bharti, which has, frankly, not done much so far. But our view on Bharti is dependent on attractive valuations and, at the same time, continuing consolidation, which will aid an industry leader like Bharti.
Well, the BSE IT index has gained about 11% since April end due to weak rupee. In your view, is there still some more upside left in large cap IT stocks?
So incidentally, the gains haven't been enough to compensate for the weaker currency. If you just taken a mathematical result, the stocks should have gained a lot more. That obviously shows that the markets are not confident of where the top line growth of this industry will lie for this year. There is a debate on whether these companies will grow 8%, 10% or even 15%, and a large part of that has been caused by the gap in performance between TCS on one hand and Infosys on the other. Our sense is that as the year goes by, we will have greater faith in the core revenue growth of the sector, which should look good. And at the same time also gain faith in their ability to defend margins on a longer term. Obviously margins do fall when large deals are won, and there could be quarterly dips in margins for vendors who are winning these deals. But the main thing that the sector needs to resolve at this time is the debate on revenue growth. We currently believe that that debate will resolve positively.
Right, so despite two big reforms in the oil and gas sector, the top two stocks, that's ONGC and Reliance, Bhavtosh, have been, underperforming. Do you like the oil and gas space in general?
So there are various other factors. If you look at Reliance, they are investing a lot of money into new projects, but the impact on earnings is still some time away. We think that the real earnings growth for Reliance will start coming from fiscal 15 onwards. If you look at the rest of the pack, it's a debate within certain skeptics on whether we should look at this pack as independent play or an extension of the government's balance sheet. So policies around the sector keep changing. The economic impact of those policies keeps changing, and that has prevented a secular story from emerging in the sector. We don't think that's likely to change, and therefore we are looking at core value in the sector wherever we can find it.
Bhavtosh, so at the current juncture, what is your take on high dividend yielding stocks like NMDC, NALCO and Coal India to some extent?
So dividend yield as a unique tool to pick stocks hasn't worked and may not work in the current environment where the Fed is likely to reduce its bond purchases. We think that dividend yield needs to be backed by the core business performance, be it in terms of revenue and earnings growth or in terms of corporate governance. And this is true for most markets. It's just not unique to India. For example, you'll find a lot of stocks in North Asia with 10% plus dividend yields that refuse to perform because their core business outlook is either quite poor or deteriorating. And I think the same criterion will continue to apply here. Within the stocks you mentioned, we like Coal India.
Any sectoral themes that you're currently bullish on?
So it's worth a watch on how the banking space performs. It's obviously the largest space in India. We have had a call on preferring private sector banks to PSU banks. That has worked. PSU banks, meanwhile, have corrected. Some of them are below book, others are approaching book value. Depends on how their credit quality parameters come out in the quarter, and if we see signs of some improvement, we could at least look at a valuation call on some of these names. Broadly, the private sector players continue to grow, they continue to have better matrices, they continue to manage their asset quality better, and so they will always have preferred place. But at the same time, some of the PSU names are also coming into the value zone.
Despite adverse news flow for this year, we've got a depreciating rupee, global concerns are sticky, investment cycle is yet to pick up. Nifty has not broken down. What is your outlook on the index for FY14?
So one of the reasons the Nifty hasn't broken below is because fund flows have helped India. And as I said at the start, they have helped India in relative terms within the emerging market universe. That we think could continue, given that macro data has worsened across the emerging markets. India is not unique there. India might have its own unique problems, but others have their own unique problems too. Is this the bottom? Will largely be decided by the elections. I don't think that there will be new bottoms formed before the elections, but if the elections throw up a fractured mandate, then India could test new lows.
Since emerging markets like Brazil, China, Indonesia and even Egypt are facing turbulent times, does this make a stronger case for FII investments in India?
Well, that case lasts for a while, but it needs to be backed by real action on the ground. So, as we have seen, the finance minister has promised and acted on a number of reform measures that needs to continue. We need to continue to try and revive the investment cycle in India, to try and repair damaged balance sheets, to try and get the interest rates in the economy down and do the right things that will make India continue to be attractive. So we have had a record amount of capital flows into the country last year, This year, India has stood out within Asian economies in terms of attracting capital, but we cannot really assume that that relative comparison will continue forever. We'll need to work hard to at least try to repair the economy as much as we can if we have to capture the share of the pie.
What is your take on rupee? Closer to 60, 60 and a half. Do you think rupee could be nearing end of its decline?
So we expect the government to come up with some sort of bond issuance, whether it's a sovereign bond that is targeted at institutional investors or an NRI bond targeted at overseas Indians is a matter of debate. But we think that the government will look at a $15 to $20 billion bond issue. Our base case is that the rupee will begin to appreciate back from the levels that it has seen. Obviously, where that point of inflection is reached is anyone's guess. The RBI has obviously stood on the sidelines of late, but we are not in the camp that believes in a unidirectional move in the rupee going forward.
Right. And as we approach the elections next year, what will be your strategy for playing the markets in these times? What is it that you're advising your clients to do?
So the last 1 year, our advice has been to have a barbell portfolio, which involves a degree of safety and a degree of risk. What percentage of your portfolio remains in the so-called safe sectors versus where you want to search for value depends on your risk appetite. But it has to be a bit of both. We have seen some sharp rallies in the last 1 year and some moments of fair amount of panic and despair. And therefore, having a 100% safe or a 100% value risk portfolio have both failed as strategies. So on the safer side of the spectrum, there's the earnings growth of healthcare, the resilience of demand for staples, the continued operational strength of private sector banks, and the regulated returns of utilities. On the riskier side are the infrastructure companies, the capital goods space, which is obviously seeing very poor order books, PSU bank stocks that have seen a correction in valuations, and we have to mix and match these, and that's what we'll continue to do.
Okay, Bhavtosh, fantastic to have you, and thank you for joining us.